So hi everyone, thank you very much for joining a Crypto Curry Club live chat on custody and compliance in institutional DeFi. So we're joined here by Alex, the CEO and founder of Trustology, Ajit from Aave, James from Gunnar Cook Law Firm, and Ryan from Coin Firm and co-host of Crypto Curry Club live chats. So everyone, thank you very much for joining. Just some practicalities. We like these Crypto Curry Club live chats to be as interactive as possible. Any comments, please do post in the chat at any time. Any questions, please post in the Q&A. If you want to ask anything directly to the panelists, raise your hand and we'll try and get to you, but any questions we will get answered. So please do post any questions or comments at any time in the Q&A. We'll get to you. I'll let all of our panelists introduce themselves just super quickly, sort of 30 seconds each, guys. And then we've got Ryan to help chair a bit of a debate here. So thank you all very much for joining. And guys, over to you. What's next with DeFi?
So should we just kick things off, perhaps going from left to right on my screen, go across the panelists. I mean, Alex, do you want to give a very, very short introduction about who you are, why you're here, what you do, and then we'll move on.
Pleasure, and thank you for having me on the show today. Alex Badlin, founder and CEO of Trustology. Trustology is a custodial wallet provider for institutional investors, service providers like brokers, exchanges, payment service providers, and other custodians, as well as for token issuers. We help them with treasury management. And one of the things that we do a lot of is DeFi. I'm pretty proud of what we're capable to do. And kind of part of that conversation is figuring out how the hell do you do KYC for DeFi. So thank you once again for having me on board, and I look forward to the conversation.
Thank you, Alex.
Fantastic. Ajit, you seem to do a few of these things. Do you want to give a quick intro in terms of your focus?
Sure. So Aave is the world's leading decentralized liquidity protocol. We have, as of today, approximately 18 billion in liquidity on the platform, which is deployed on the public Ethereum blockchain. Aave was started by Stani Kulechov and Jordan back in 2017. So it's one of the earliest innovations projects in DeFi, and it's currently it has over 200,000 plus users every month, 50,000 plus direct Ethereum addresses using it directly. So my focus is on institutional growth, essentially bridging the gap between DeFi and mainstream financial institutions. And we're also going to be deploying the permission version of Aave for institutional users in the near future that are, for various reasons, cannot use DeFi in its current environment.
Very good. And James, would you like to give us a quick intro?
Hi, I'm James Burney. I'm a partner at law firm Gunnar Cook, which means I like virtual events because it means it's harder to throw things at me when I'm unpopular in the room. Worked on the first successful ICO in the UK, first executions on chain, working now with NFTs and DeFi custodians across the board, particularly with a regulatory focus, just because I'm a regulatory lawyer and the two go together.
Thank you. And Ryan, you do.
I get to do an intro this time round. Wonderful.
You get to do an intro this time round.
Oh wow, amazing. I'm Ryan Hanley. We've seen two sides of this debate, formerly of Token Market, where, as Ajit puts it, launched 1,000 tokens, utility mainly, fully compliant, of course. And I'm now working for Coin Firm, who provide AML services into the cryptocurrency world. So we do a fair amount looking at how we can analyze transactions and understand how dodgy they look. So we've been doing a lot of work on DeFi on both the supply and also the demand side as well. Wonderful. So thank you guys so much for coming and joining us, especially as we are seeing the markets crash somewhat. So thank you everyone who's also joined in the crowds and taking yourselves away from screens of grass going through the floor. Just to kind of set the scene, within this sort of webinar, what we do like is to have a little bit of interaction, so it's just not me or Ajit babbling on about various subjects and talking about PR. We like to get questions in. We will try and get into them as we have the discussion and as it's ongoing and flowing, and we'll try to get to a few at the end as well. Thank you so much, panelists, for joining us. I think we've got a really great, well-rounded expert panel to talk about probably one of the hottest subjects within cryptocurrency outside of Chinese mining. One thing I'd love to go into first is maybe just to set the scene a little bit. I know we've all sort of been through a few of these DeFi webinars before, but when we talk about compliance and regulation, it's very hard to come up with a definitive answer on what we should be doing in this new paradigm. Ajit, maybe I'll throw this first question to you. So, you've seen it from both sides. So why is DeFi? Why is it so hard to regulate?
I don't think it is, so first of all, there is an assumption in that question that I don't agree with. And so I think, financial regulation is pretty well laid out. And there is, different parts to regulation. There is obviously conduct and KYC and transaction monitoring, AML regulation. And then there is, a whole bunch of prudential regulation around capital efficiency, customer asset protection, cybersecurity, and so on. So I think it's important to understand what DeFi is first. So with DeFi, what we are seeing is, the evolution of market infrastructure on the public blockchain, right? So what we're looking at is very, very early days of just a whole new way of building market infrastructure in a very transparent, automated, and open source way, right? So for example, Aave, Uniswap, a whole bunch of other protocols are all community governed, and all of the source code for building, and how these are deployed is available on GitHub. Now, all of the data that's transactions that are processed are also, can be essentially reviewed or can be presented on a dashboard by third parties like Nansen and so on. So this level of transparency, this level of permissionless innovation, where everyone in the world can contribute to the growth of this infrastructure, is a completely different way of thinking about how we have put together financial services. Now we assume that regulation in current financial services is working, and it turns out it isn't, right? So I mean, we see every year we see accidents like Archegos and massive systemic risk incidents. We see a number of cybersecurity incidents. Some of the largest banks in the world who don't give access to crypto are actually known for involvement in some $200+ billion money laundering incidents. So it's an assumption that somehow regulation as it's put together is working, and it's not working because it's currently all paper based. It's based on manual processes. It's based on rules and rules upon rules upon rules, and then an army of auditors, lawyers, and what I call priests is required to enforce this regulation. So regulation isn't working, and it's important to find a way to put together financial infrastructure that allows that relies on transparency and automation and creates a far more efficient infrastructure for financial services. So I know the topic of this panel is to bring compliance to DeFi. I would take a different approach and say maybe we need to bring DeFi to compliance, right? And sort of rewire the entire financial system for greater inclusion and transparency.
Okay, strong views off the bat from you, Ajit. So, I mean, obviously we do have certain rules, regulations in place, and some of them, they are going to be applied in a certain framework to transactions which are happening across DeFi. I mean, Alex, maybe this is something you'd like to weigh in on. You obviously come more from the demand side. You're seeing, an appetite from, let's say, more traditional institutions to be able to access DeFi, to be able to interact with some of the protocols. Ajit obviously spoke about some of the regulation, which he believes is maybe ill-fitting in general, not just towards DeFi, ineffective even. What's the sort of the hold-up for the institutions from your side? What are the things which are missing for them to really be able to start taking, a large stake within this world, or are they already here?
I guess probably worth looking at it from a couple of angles. So first one is demand. Who wants DeFi? And one of the constituents, obviously investors, DeFi funds, yield funds, and so on. Why? Frankly, right now it's a pretty easy way to run a fund and get pretty good return. You can take some fiat, convert it to USDC, put it into make it out to give you a bit of leverage, and to compound, maybe do a bit of yield farming, and way presto, with very little work, you got 20 to 25% return, which frankly in traditional space you would be pushed to do. So there's an obvious immediate kind of temptation for funds. Secondly, I think given the highly automated nature of all of those processes, longer term, you would expect the fees to be a lot lower. We're seeing kind of Curve Finance and others right now effectively running very sophisticated algorithms, recycling different investment opportunities. You'll be paying huge amounts of money compared to what the protocols are taking right now for a professional centralized service to do that. So, and as time goes on, those kind of going to be cheaper and cheaper as it's fully automated. And then, of course, even kind of we're now starting to see other folks who are simply looking for liquidity. Listing fees on centralized exchanges are pretty high, whilst kind of listing on Uniswap is virtually free, once you take out the gas fees. Therefore, if you just want access to liquidity, that's for more niche tokens, it's a pretty good option. And then, of course, we're starting to see sometimes depth of liquidity being better on Uniswap with less slippage than centralized exchanges, because more people are willing to trust the decentralized services across the world, which builds a deeper liquidity pool. So the demand is clearly there, and I think there is a systemic long-term demand. So what's preventing some entities joining in? Well, some are not being prevented, they're jumping in. Yeah. So first of all, to say that no one's jumping in is wrong. Those folks who are very traditional, as in like majority of people, will be hesitant because frankly, they're probably doing quite well already in traditional markets, and therefore the risk reward equation may not always be there. If you have a brand new fund focused on crypto, it's much easier. There's less contagion to be had. But I think people are slowly moving into this space. I think the other issue, which a lot of the time technologists forget, it's hard to get your head around this space. We talk about this kind of what's preventing. Actually, I think understanding. Vast majority of people, when I talk to them, have no clue what a smart contract is. There's a huge amount of, frankly, awful marketing by tech people. Smart contract, that's not a contract, nor is it smart. Tokens, which are not really tokens, but ETXOs, coins that are not coins, and who owns and devises the protocol. So I think there's a lot of really bad information out there. So I think that's one of the key things. If people just spoke more plainly, I think people would be able to adopt those solutions a lot more.
So so you've brought some really good points there. One I want to hang on a little bit, because I think it's quite prescient based on some of the activities of last week, is as an industry, are we doing enough to self-regulate? So you talk about different token classes, utilities and what have you. Is there enough good information and good acting in the space from within the industry itself to self-regulate? So we saw a rich billionaire lose a lot of money last week on an algorithmic stablecoin. And the initial reaction from that very rich billionaire was, this should be regulated. We should regulate stablecoins and say what stablecoins should actually be and what counts and what doesn't. James, you're probably the finest legal minds on this call. Where do you think that sort of grey area sits? Do you think there needs to be more self-regulation from within the industry to allow regulators to become more comfortable? Where do you sort of sit on that?
I love the word regulation, because every time you meet someone that tells you how you want to be regulators, and then when you go, what does that mean? They look at you entirely blankly. Regulation in and of itself is not necessarily either a good thing or a bad thing. The question is, what are you telling people to do? If you go to all the regulators of the world and you go regulate and do the right thing, no one's going to disagree with you. Each regulator can't agree on what that means. So if you take just at the very, very macro level, China believes in the power of the state. Therefore, the end goal is what benefits the state. US is more about the power of the company. So look at it from a corporate perspective. The EU, it's about the individual. So I always find it quite funny when people say, we need to fix regulation or we need regulation. And it's a pretty meaningless statement. What you've got at the moment is you've got certain things which people agreed are bad things. So that's like, we do not want to sponsor terrorism. Most people, as long as it's not being called a terrorist, feel that this is a good thing. So the first question then becomes, well, what is a terrorist? Because that will actually depend on which country you're in, and different people will take different views. The next question then becomes, well, how do we stop it? How far do you go back? And to give you a sort of idiot example, if you take the £20 note and you run it through a spectrum analysis, about 80% have got traces of cocaine on them, if you judge by the research. But every time you buy a sandwich at Pret, you don't go and get your £20 note checked for traces of cocaine. But if you want to be absolutely crystal clear, that's something you could do. You take Bitcoin, okay, we talk about the percentage which may be linked to money laundering, but what is the acceptable number? What is the right number? And it brings up a huge question as to, what do we want to achieve? What can we achieve? What should we achieve? And the Uniswap to me is a great example, because Uniswap is intrinsically a very cheap place to do transactions because they don't bother with AML. There is a cost to all of this, and it's not a straight answer of, this is good or this is bad. It's weighing up the cost of the industry and the players and so on. And then you've got the rules themselves, which, bless their cotton socks, were created in the world many years ago, where if you take something as simple as AML, that was all based on the assumption I had a client, I meet my client, I see my client, I see their documents. If they don't show me their documents, there's something they're hiding. But you've had data breaches since then, so people query as to whether you should be passing on personal data at that level. And you've got things like DeFi, which mean you don't have to meet people. So the underlying assumptions in which they're built no longer apply. So to me, there's a massive need to step back. And just going to the last part of your question as to whether there's a self-regulating, I do not believe there is a self-regulating entity out there of the variety that people are taking intrinsically incredibly seriously at the moment. I think there are people moving in that direction, but we're not there yet. And that isn't a sort of trust in me type thing from the Jungle Book, which is what you get to see, which, I am special, trust in me, all will be fine, pay many fees, nothing like that. You need something which is purely independent, which actively recognizes the weaknesses within the system around things like education and tries to deal with them. And if you look at other established industries, the industry bodies they tend to have in place do not always just go, we are wonderful. They are trying to take a step back to actually work out where the weaknesses are, acknowledge those weaknesses, address those weaknesses, and then you have a far more adult conversation with regulators and the like, whereas if you just go, we are wonderful, we can never do wrong, then you won't be taken seriously.
Also, to touch on
Ryan, let me just say that I never took you for a regulation maximalist.
Absolutely not.
But it must be the logo behind you. Anyways, so I think let's think about regulation from an economist's perspective, right? So regulation is not something you think of first up. So regulation is required because there are market failures, right? If in a world where free markets work and work completely well, no regulation is required. So self-regulation itself is a word that I don't fully understand, right? I've heard that thing in banking for years, and somehow, if you remember a guy called Bernie Madoff, he used to be the chairman of NASD, right? The National Association of Securities Dealers. Now, self-regulation is not a thing, right? So, but the question is, what are we actually trying to achieve with regulation? With regulation, we are trying to prevent market failure and protect consumers, right? So that's the main thing. Now, so when we think about regulation, then there is either prudential regulation or there is conduct and anti-AML CFT regulation. Now, the question is, there are principles and objectives of these regulations, and there is the form. So what has happened is that over the years, since the 1934 Act and so on, we have created so many rules to fix previously broken rules. We created Dodd-Frank when there was financial crisis, and Dodd-Frank, didn't actually fix it. We created even more regulators. Now we have 6 US regulators and 50 plus state regulators. Now it's impossible to determine who actually regulates Bitcoin or Ethereum or the thousands of tokens and so on, right? So I think regulation, there is a form and there is the principles and objectives. So what we're trying to do with DeFi is sort of look at the principles and objectives and say, look, from the first principles, what is the idea? The idea is more transparency, greater automation, right? Just to reduce the cost of compliance, because cost of compliance locks out a lot of users, right? There are billions of billions of people who currently cannot access financial systems because of the cost of KYC, AML, and everything, right? Most people in Indonesia don't even have a last name. So you're never going to get the passport and the proof of address and the utility bills that you assume in the UK. So I think we have managed to, and we haven't really fixed money laundering, right, with the AML rules. So yeah, sure, there are rules, but have we fixed anything? I mean, we had Danske Bank, we had HSBC, we have had thousands of these, every year we get one or the other. So I think, so every time we speak to regulators, we get a very favorable, and compassionate hearing, which is, okay, we understand that there is probably, new technology and our regulation and how we enforce and how we build things is built for legacy technology. It's built for an era of paper, and regulators like the FC are trying to digitize as much as possible, right? So now if we can create infrastructure that is built from a different set of, components, and think about this in the 10, 20 years time frame, right? So we're looking at the second year of DeFi. When you really project this forwards and say, look, what does this actually look like? And there was a stat by Santiago Royal yesterday on Twitter saying, in 50 years, we haven't renewed some of the systems that DTCC is currently using, right? So we have a problem. We have crumbling infrastructure in financial markets that actually isn't serving anybody. So there is clearly, so let's think about, what are we actually trying to achieve with regulation, and how can we work with this new technology and new infrastructure to achieve the principles and objectives of regulation? And you're not going to have risk-free innovation, right? So there is the reason. I used to work in enterprise blockchain, and we never actually, there were so many PowerPoints and no one actually delivered anything. So, a lot of those blockchain projects are now dropping blockchain out of them. So with DeFi, in 2 years, we've delivered, technology and infrastructure that actually works. Now, of course, there is a need to make it more secure, more, privacy sensitive, more robust. Yeah, but we're looking at year 2 of this technology, projected 10 years ahead, and it looks completely different. So I think there's one more point there, right? So regulation, if you start with regulation first, you get Europe. And European economy is falling behind China and the US, right? That's because we are regulation first. We regulate before we innovate. So whereas with China and, so what you do is you create technology. The technology creates markets. And then once those markets exist and there are some imperfections in those markets and potential market failures, then you regulate. So I think we need to think about, what opportunities this new technology and, this new architecture is able to create for consumers and for, market infrastructure. And then we think about, based on the opportunities and the risks and the balance, how do we sort of regulate this new thing, as opposed to saying, hey, this is the regulation we built for the last 100 years of legacy infrastructure and legacy processes and manual paper-based world, and we're going to just apply it to all of this new opportunity. So we'll throw the baby out with the bathwater because we're just so worried and we want to just enforce the rules we've always had. Right? I don't think that's the way to do it.
So to turn the traditional sort of question, sorry, Ryan, just a little on its head from what you guys have said, well, a few people are of the opinion that DeFi will soon just become Fi, that sort of what is now called decentralized finance will soon just be finance in the general term. And so how much of the onus would you say should be on traditional finance to then look at the DeFi startups and innovation and how they can learn from the DeFi startups and how they can innovate? And is there an onus on traditional finance to look at that way? Do you think that is likely? Do you think that it's realistic? Alex, it'd be good to get your viewpoint on that.
Sure. I don't think there's any onus on anybody. I think ultimately, if it's useful, people will copy it, and if it's not useful, people will ignore it. I think it's interesting listening to Ajay kind of, I have the rather depressing job of looking at hundreds of transactions on a daily basis, because Custodians is a custodian wallet provider. We register with the FCA, so I actually have to review all the transactions on a daily basis. And it's all kind of great to talk about in principles, but in practice, I have to do this on behalf of my customers, kind of. And to be honest, as much as people kind of whinge about kind of regulation and their super points, there are some practical things we can be doing. If you look at the JMLSG, the Joint Money Laundering Steering Group in UK, they've advised, and FCA has accepted, a risk-based approach. So what does that actually mean? It means that in traditional banking, because everything is done by banks, you always know the name of the person sending the money and receiving the money. In crypto, they accepted that in some cases you might know one or the other entity, the counterparty, but not the other. So we take the risk-based approach with excellent data from companies like CoinFirm. So as much as people kind of try and talk about regulation being flexible, frankly, I think if you're an FCA, you probably come back and say they've been amazingly flexible because they allow the risk-based approach, which is completely different to what they were comfortable with beforehand. And then secondly, kind of DeFi. DeFi, and as I said, if we remove all the marketing crowd out there that people talk about, it's a smart contract. It's a bit of code. So we're doing something quite mundane and both incredible at the same time. Instead of having a counterparty that's a human being, or a counterparty that's a collection of human beings, otherwise known as a company, governed by Companies Act and other legal documents, you now have a counterparty that is code that's executed on the blockchain, which was written by somebody who you don't know. And the first response to that is like, oh my God, how the hell can I work with it? On the flip side, actually, I'd much prefer to work with code than with human beings because they're entirely predictable. I can read the code, and the code is executed by thousands of people. So it's very unlikely that any single individual will be able to cheat on the execution of the code. And having been able to read the code, I'll know, for instance, whether or not that code is acting as a mixer, which is a common layering technique for money laundering, or if it's an atomic swap, that's not very. So then we can take a risk-based approach and say, actually, what does this code do? And this code mixes stuff. Aha, okay, inherently it's risky. What do we do with risky counterparties? We do enhanced due diligence. Right. And then once we look at enhanced due diligence, what does that look like? Well, frankly, just because you might be risky, but you're doing all the right things, doesn't mean you should be barred. If you're risky and you're doing bad stuff, then maybe you should be looked at more closely. So then you start to look at behavior. How much dirty money is coming into Aave or Uniswap or whatever it is. And the more it comes from dark markets, the more likely it is that, frankly, we would be advising our customers not to use that. So I just wanted to bring this conversation to something a bit practical because I think it's all too easy to kind of go in the clouds and kind of slag everything out off. One of the things I love about DeFi is that, just like Ajit, having worked in enterprise blockchain for years and not achieved much, I'm seeing shit getting done. And that's why I don't want to get us into the kind of whole thing of hand waving a lot. No, there are ways we can do that. We're doing this today on a practical level and love to work with people who want actually to get things done, but in a regulated way. It is possible.
I think there's some really good points you brought up there, Alex. And one thing I maybe will throw over to James a little bit more on is it's this nature of risk-based management and in principle regulation as well, which is what we have in Europe. So this is where you know, things are somewhat grey as you're applying certain strategies in terms of how you are perceiving something as risky within DeFi. And obviously at CoinFirm, we do a lot on the analytics side because you have this transparency. You're able to see 30 hops back, you can risk score in these various different ways, you can look at various different flags. But sometimes that is difficult as you go through regulation because especially when it's in principle in this kind of very new paradigm, the regulators are always playing catch up. They don't quite understand it. They're continually trying to learn. And then they're also kind of somewhat moving the goalposts as you go along as well. And, you know, I've seen this from the other side as well. James, just because we have, I think, probably some of the FCA here, so it's a good time to ask these questions. We have 4 crypto licenses, maybe 5, which have been passed out of hundreds of submissions. Where do you think the major stopgaps are within the UK when we're looking to regulate crypto in general? Is it the matter of liabilities, counterparties? You know, what are you sort of seeing from your side in terms of how the regulators are looking for? What looks good at this point in time in terms of, you know, good due process?
So I think the first point to recognize is there's been a massive culture change in the regulation of crypto. I started off sort of way back when on the first ICO and no one knew what I was talking about at all. And it was this weird thing for lunatics who all understood what was going on. And it kind of just happened, and it was all small scale, so not to worry about it. It then became interesting, and now we're worrying about it becoming large, systemic, and people coming to who don't understand it. And so as a result, what you see is reaction by the regulator from, oh, it's a bit of a laugh, oh, it's just people who understand it, to now actually, widows and orphans can buy this stuff and they could be seriously hurt as a result of it. So you're going to get that sea change. And I always find it quite funny when people talk about, the principle-based approach or the checkbox approach. Bluntly, neither totally work, but you've got one of two options. If you go for the checkbox approach, you know exactly what you've got to do. You tick all the boxes, you're a happy chappy. But you can't innovate, you can't come up with something new, you can't argue this is the way it ought to be. If you take the principles approach, then you don't have any fixed boxes, but risk-based approach. And I sat through one thing where I had someone trying to argue that selling derivatives in crypto to 8-year-old boys was a low-risk activity, at which point I'm sitting there going, we're just going to go to jail, let's just save all the paperwork. Yet he was entirely convinced in his mind that somehow this was low risk because, DeFi, and DeFi is above the law, so we don't need to worry about any of that horrible lawyer stuff. So you've got to hear exactly what they're coming from. And yes, they are changing because they're moving with the times. And from their perspective, they see this as actively evolving piece and they're evolving. They think that you should be evolving with them. And to give you an idea of the sorts of things we're seeing where it's going wrong, it's called registration. Well, at the beginning, it was almost pitched like a light touch registration approach. I don't think anybody believes that now in the slightest. It's probably one of the most hardcore authorizations you can probably go through. I have full admiration for people who do it, and I'm glad it's not me. There's then sounding like the sort of person I want to sound like, because if you take a step back, there has been various bits of guidance by FATF and all the rest of it pointing out all of the specific risks in crypto. And there is a high chance that the applications which have gone in haven't mentioned any of those. Have completely ignored everything the regulators have said about crypto. They are sticking this stuff out there for a reason, and it's not actually just to have fun. They want you to read it, understand it, reflect their concerns back to them, how they've done it. They're not, they are worried at the moment. And it's not crypto specific either. What I'm trying to get at is if you take, we've had Neil Woodford, we've had problems around that. We've had other issues. The FCA have been criticized for not going as far as they should, not being as active as they should, and all the rest of it. So across the board, not just crypto, the FCA is evaluating its position, figuring out how it wants to do things, taking a harder stance. At the same time, it's doing a Brexit, and at the same time, it's doing COVID, so it's going much slower. So as soon as you say the word crypto, you have immediately flagged to the world you're in a higher risk activity. And no matter what you say, that is the opening starting point. If you then go, trust me, it'll all be fine, you sound like every single derivatives trader at Lehman Brothers just before the whole thing exploded. So that's a dead man walking, that as an argument. You've got to find out exactly what they want and you've got to give it to them, and to be completely blunt and horrible about it, this is not a cheap process, if you see what I mean. Now, your option B, you should go abroad, you do a Uniswap, disappear from the UK, go out the UK, set up abroad, no public service in the UK, and stay outside the rules. Now that is, as of today, something that people are doing. Now, it's been done before, so if you take things like the hedge fund world, they did the same thing. You then get regulation of advertisement coming into the UK, and that's what we're going to see over the next year or so. And you're going to get a split between those countries you can appeal, you can get into on a sort of low-cost basis, and those you can't. But at the end of the day, getting registered or authorized with the FCA is seen as a privilege, not a right. So you have to convince the FCA that you are worthy of that privilege. So if you go in and you go, I demand this because I have a right to it, you'll simply never get off the ground. You've got to listen to what's saying where they're going. And they've had something like a 90% failure rate. So they are taking this seriously. And from their perspective, if you threaten, I'm off to go work in the BVI, because no rules there, fine, it's no longer their problem. You don't get the credibility of being in the UK. So the question from your perspective is, what is it you're looking to achieve and why you want to achieve that? Are you someone who wants to live in the BVI and do it that way on a cost basis? Fine, that is an option. Are you someone who wants to work in the UK and have the tag of being an FCA registered firm? Different option, different profile, different cost base. But I mean, it's an entirely different way. And if the FCA are listening, which by and large, I'm probably going to say this, but from our perspective as a country, we are very good at giving out the stick, i.e., you see all the things that are bad. Carrot is nice. because actually, there are good things going on. There are bits where traditional finance can learn from crypto. It is not all bad. There are actually quite a lot of good out there. Yes, there are some bad things, but there are bad things in most financial services sectors, if you see what I mean. So the idea that everyone in any sector is a total saint is just naive. So the thing I would always push for is, it's very serious things have gone wrong, but actually come together and sharing good practice, what people want to see, the right answer. That is something I think we need more of in the UK. And that also encourages people to say, this is not a one-sided affair. This is trying to grow the industry. And I think we will get there, but it's going to be slow. And you're going to get a focus on getting on the bad before you get a focus on the good, because to be completely blunt about it, the regulator is going to want to close down things it seems as fraudulent, bad, and awful before it starts opening the doors up to things, because the FCA will not want to get criticised for not having closed something bad down fast enough. So you're going to get the bad before you get the good.
Very good.
Yeah.
And so, Ajay, I was actually had a question lined up for you specifically on this fact. So we've had certain amounts of guidance over the last year, and we see stuff from MiCA, we see stuff from various other bodies and what have you. I think it's fair to say protocols are now starting to take this a little bit more seriously as the the total value locked is getting larger and larger. But obviously it will be a bit of a staged process. How do you see that kind of shaping out? I mean, it's been leaked, it's been leaked already with Aave and Aave Pro and a few of the the kind of the votes which have been pushed forward in terms of some more, let's say, specifics around the KYC AML angle. How do you sort of see that panning out over the next 6 to 12 months from a protocol perspective?
Yeah, I think, see, a couple of things, right? Alex pointed out quite eloquently that it's much more straightforward to do AML, transaction monitoring and suspicious activity reporting on chain transactions, right? So if the transactions are across multiple databases, then then banks have to choose what to see, because if they see it, they can't unsee it, right? And I used to work for an audit firm, and I've been through AML compliance and remediation programs for banks, and banks are just great at not seeing things they don't want to see, because otherwise they will have to deal with that. So with on-chain transactions, you simply can't do that, right? It's all on-chain. The regulator can do it themselves, and if you're not doing what they think you're doing, they can just pick up the phone to you and call you, right? So that's the first thing. The second thing is, the code is there. I mean, and this DeFi conversation, I was in Morocco with the chairman of Deutsche Börse, and he said, why do I have to write all this code? Why am I building infrastructure when all of this blockchain stuff is supposed to be open source? So really smart people in financial infrastructure get it, right? Now, what we're doing at Aave and in other DeFi protocols is we're building software. We're not operating a financial service. We're building software, and that software has various applications, right? So now software is like speech. I mean, it's not something you can regulate. Now the service, right? All of this infrastructure will then be composed into services and still be delivered by certain intermediaries. So whether it's wallets or, neobanks or, market infrastructure operators and so on, they will take all of these pieces of infrastructure or the software we and others are building, and then compose it into financial applications that are then delivered through the front ends, right? And on those front ends, you will need KYC. I mean, because that's the geopolitics of it. You can't, philosophically, a lot of people in crypto may not agree with it. It might be a net negative to society, but that's the law. So the law has to be followed, right? So on the front ends, we will have to, all of the front ends who are actually delivering and are interacting with consumers and delivering a financial service will have to do, at some point have to do KYC and transaction monitoring, right? And whatever else the rules are. So think about this as, I think that distinction between software and infrastructure and financial service is very, very relevant, right? So let's not mix the three things. So software is not regulated and shouldn't be regulated, otherwise we'll kill innovation. Infrastructure, sure, there will be certain rules around infrastructure, typically prudential rules around cybersecurity, resilience, and so on. And then there is the actual delivery of the service. Now, one thing I would like to point out, right? On the 19th of May, every single centralized crypto exchange was down. Guess what was not down? Aave wasn't down. Any of the Uniswap wasn't down. Maker wasn't down. None of the major DeFi protocols were down. We had 135 million in liquidations, but Aave ran like clockwork. So something is going right. And maybe we should think about that too, right? So I mean, when we think about regulation, the thing is, I mean, the best thing a regulator can have is to not need to have all these thousands of rules and an army of auditors enforcing these rules.
It's a little bit idealistic, Ajay. I mean, when you talk about everything going down, but you know, when everything is wrapped into smart contracts and you have no outside credit risk, you have no outside credit risk. They're coming into DeFi
But the
at the
consumer is
moment.
paying for regulation, right? So how do we take the cost out? Deutsche Bank has a 60-70% cost of income ratio. How do we take that out? It's not a matter of idealism. It's a matter of really long-term practicality. How do we actually make financial services accessible for consumers? Maybe new thinking is required, right? And we're not going to do that by sending auditors to look at it, right?
Absolutely, I couldn't agree more. I mean, the thing that we also have to kind of look at is, you know, is it fair that the KYC responsibilities gets pushed onto centralized exchanges, which is what's happened at the moment. So
who is onboarding the consumer?
Well, they are onboarding the consumers, but there is also people
who
launch a protocol who also profit from that protocol.
Whoever has
so as much as we talk about the software
relationship, wait. Whoever has the customer relationship is going to have to do KYC, right? I mean, if the bank onboards a customer, it's not Visa who does KYC for the bank. That's just how it works today. I mean, there is nothing new here.
But it's naive for us to say that once a protocol has been deployed,
I'm just stating a fact.
Someone who's deployed that protocol does not profit from that protocol being used. So when the regulators look at this, and we've seen it from the US, where they classify MSBs as things like Ether Delta, where there's a previous case, and we look at, you know, the nature of things like governance tokens and tokens which are launched sometimes anonymously, which then earn yield and revenue from a protocol. This is where we have this, you know, nature of conversations around VASPs, because it's, you know, at one point, and it's very unclear at the moment, I will freely admit it, you know, you can, software engineers, you know, should not be liable.
No. But
however, if they profit from what gets deployed, then,
yeah, but this is not a matter of opinion. This is not a matter of opinion. So this is how KYC rules work today. The person who is the entity that is actually onboarding a customer and has the relationship with the customer and is able to actually KYC, I mean, that's how it works. Travel rule is the entity that is actually responsible for knowing the customer because it's their customer. They're not the customer of Visa, they're the customer of a bank. So the bank does KYC. There's nothing new here. So even the FinCEN's midnight rulemaking works exactly the same, and there's nothing new. And we're not describing what is in the interest of software engineers. We're describing how things work.
I think what's interesting.
You, Alex.
I was going to say it's one of the more philosophical questions, and maybe worth kind of. I totally agree. Who the customer, you know, the best person to understand if there's money laundering is someone who is providing an end service. And you know, if you look at the 5th AML directive, they're starting to talk about estate agents and other service providers looking to the AML. And frankly, in a lot of the time, the bank is probably not the best person or best entity to do money laundering detection because they're simply middle person shifting bytes and bobs. Why don't we then get BT to be kind of doing compliance checks because data goes through their networks? So I think, you know, there is a more fundamental question. Should kind of compliance monitoring be pushed to the utter edge of someone who genuinely understands the relationship rather than a pass-through agent like a crypto custodian or not? I think that there is a big question to ask there. And then secondly, kind of course, is the cost benefit question. There's a lot of study there that frankly, right now, the cost of regulation versus the amount of bad activity that's being captured is disproportionate. And actually, you know, if you look at people who can't afford to engage in financial services as a result, end up going to black markets where they're abused. So I'm not entirely convinced right now the balance is 100% correct, because I think over-compliance is then driving the people who are most vulnerable away from kind of services that they should be able to get, and therefore actually regulation contributes potentially to money laundering because they're forced to go underground. So as a society, a much bigger question is, have we got the right set of tensions? And I'm not entirely convinced right now. So it doesn't mean we shouldn't do that, but we do have to discuss the cost benefit to the society.
on the other hand, we haven't built the digital infrastructure, right? We haven't even got digital identity infrastructure that would create a shared utility for banks to essentially reduce the cost of compliance. We're not actually solving the problem. We're just creating more rules to make it even harder for people to comply.
There's a total lack of innovation on AML, and it's still based on the old notion that you go to a guy, give him your passport. If you didn't give him it, you're somehow dodgy, and that's how it should work. Yet, because I was involved in one transaction where A is selling to B, 3 rounds of AML were done by each firm. No firm was comfortable relying on the AML done by any other firm, so we literally had the same process 3 times, which triples the cost, yet it's exactly the same process. Probably using exactly the same people to do it as well in one of those sorts of moments of madness. So to me, there's, the AML rule, no one I think is defending the AML rules as fit for purpose for the modern climate, in the sense they were built as, in an old world which doesn't exist anymore. And I think the biggest change I would like to see is clarity around the ability of different people to rely on AML done by a trusted third party. And this is why I think it actually makes sense for the regulators almost to step in and go, we have announced that this entity here does KYC and AML. And yes, it might be systemically important and all the rest, and I get that, but you have the backup procedures in case it doesn't go through, and you have it properly regulated, because all you care about, and I think that's hilarious when I have clients and I'm onboarding them as a lawyer, you come to me, I go, great, can I see all your personal details, please? You go, yeah, here you go, here's my passport, here's my utility bill, all this stuff. Now, bluntly, why are you trusting me with that? Because I don't need to know it. I ask for it because I've got to ask for it. I tick a couple of boxes, I'm high delighted with myself, and then I can represent you. If I could simply go to, AML.com, stick in your name and get a yes, no answer, that should be enough, because I don't need to know more than that. And, the other thing is these rules were created pre-GDPR, pre-personal data, and there's a psychological difference here. And it's one of the things which I find absolutely fascinating about the whole ecosystem. You've got different generations have different worldviews. At the moment, the people who are making the rules are the middle generation who grew up in the world pre-crypto, who have nice cushy jobs when they get paid quite a lot of money for the world as it is. And why on earth would you ruin that? And one of the things I find hilarious is talking to lawyers, because you speak to partners, we do well with existing systems. Try and imagine, you have your trusted international advisor, and they do solid things, and you make money, and you're highly delighted. And you're sitting there going, well, bluntly, having represented fund managers, you're paying for the fund manager advisor, the fund manager itself, the second fund, the custodian, this, that, the other. And yeah, okay, you might get some money at the end of it, but okay, whatever floats your boat. And then you've got a younger generation who can't even access that, don't understand it. And my favorite question to ask all people is, what do you think of shares? Because if you ask fund managers what they think of shares, they ask, it's not a right to dividend. Ownership of a company. What do you control? You don't have any rights whatever the company gives you. It's this amazing black box. Yeah, what a share is? It's the right to a percentage of the amount in the company in the event of a liquidation. So basically, it's a right to about 7%, maybe 5% or whatever the company has at the moment. And yet we're happy with that. And at the same time with crypto, we're going, it's dodgy, it's weird, we don't get it. Yet at least you can read the white paper, but it might be virtually illiterate and make no sense, but it's an attempt to explain what it means, we see what I mean, even the worst ones. So, this is where you've got a huge cultural divide. And I'm really seeing a younger generation who prefer the token which they can read and they can understand and know what they're getting versus the share. And my model needs to adapt similarly. And I think we're going to be stuck down a dark hole until we get to the point where you can have actual proper innovation in the AML sector, which is looked at seriously. And completely blunt about it. The whole purpose of Brexit was we could change rules. This is gagging for it. This is it.
Sorry, I didn't mean to interrupt, but that's what I meant when I said we need to bring DeFi to compliance, not compliance to DeFi, right? So by which I mean, we don't have digital identity infrastructure, right? We don't have digital reputation infrastructure. You add identity and reputation on top of DeFi, which are decentralized, right? And like utilities, potentially even state created, whatever. And I mean, you get a whole other far more robust and transparent financial infrastructure. We just haven't built. We can't get gov.uk.verify to work. Maybe we should fix that first. So once you add, digital KYC utilities, and we get, reputation systems where you can say, look, oh, we have all of this shared credit data from Equifax and whatever. We can build far more sophisticated systems. We need to bring this on-chain digital infrastructure to compliance, not the other way around. I mean, the other way around will happen, but it's happening anyway.
I can't believe we've gone this direction. So are we proposing that the way to fix the compliance issue is to have centralized government KYC, on-chain identity, and then we can trust that, and then we can bring that into DeFi, and then DeFi can work? Is that what we're proposing?
Who is enforcing the rules?
One of the main problems I constantly hear from DeFi startups on an almost daily basis is they want to get to AML, they want to do all of these checks, they want to get regulated. How do they get that? Who can they talk to? How can they make it happen? And there isn't an answer to that currently.
There is on this call.
but it's a bit like working inside the bank. I used to tear my hair out. So you go to the internal compliance team, security and compliance, and you go, can I do the following? And they were like, can't tell you. You have to do it, and we'll tell you if we'll shut you down once you've done it. And it's still the same here, kind of. So the only kind of advice I can give is read the regulation, read the guidelines, don't be a dick, come up with a system that you think is reasonable, write it down, and take the time to explain it to the auditors and the regulators. And quite often, most of the time I found, not always, but most of the time, you will get legal opinion too. Thank you on the chat.
That was pitted by a lawyer.
Yeah, no, true. It's true. It just allows somebody else to kind of think through your logic.
It exists that lawyers can get richer. Let's face it.
Exactly. and then write it all down, and then you'll probably get a grace period where even if you're doing a bunch of stuff not quite right, then at least you'll get, this is what you need to change. Here's the 6 months or 12 months remediation window, and you work through that. It's extremely frustrating. Absolutely. It's kind of been on it a couple of times at the banks, but I haven't got a better mechanism.
Yeah, on our side, we have been very proactive in our approach to regulators and policymakers. So Bustani, Jordan, and I presented to the Bank of England last week as to how DeFi works, what Aave does, what's going on. We've done the same with the FCA, with the FATF, the OECD, the SEC, and you name it, right? We're out there sort of being very proactive and sort of educating, influencing, but also, just sharing expertise as to where we are actually going with this. So I think it's also upon the crypto community to take a proactive view, right? Because what we are saying ultimately is that there is new technology, there is probably a better way of doing things. So it's upon us to essentially engage in that dialogue and create that dialogue with the regulators and policymakers. So I think it'll be a mistake to assume that regulation, is going to change dramatically in the short term. It'll also be a mistake to assume that regulation is a constant and independent of technology and markets. Regulation is a fixed, constant, and it never changes. I think it's important to sort of, and the FCA has been very, very favorable to fintech and innovation more broadly, right, over the last 10 years. So we get a lot of favorable conversations with regulators where we are sort of, saying, look, let's, this is early days. We are looking at an 70-80 billion industry on what, 7 trillion US alternative asset market. We are now big enough to be taken seriously and to be a factor in regulatory and policy discussions, but we're not too big where it becomes quite a material risk for the economy or the consumer and so on, right? So I think this is a perfect time for us as a sector, as an industry, as innovators to engage with regulators and say, how do we create an environment where we can innovate in a way that doesn't create unnecessary risks for the consumer. So we're getting there, and it's also a matter of culture and practice, right? How do we deploy software in a controlled, tested, well-audited way? How do we actually make sure that our software is secure before it's deployed so that consumers don't lose money? What sort of culture and practices do we need in the industry? So a lot of these things, right, to come into what the regulators call controls. And then it's a matter of, ultimately it's a risk-based approach, and then it's controls, right? So Alex, those two things go hand in hand. So what sort of controls are required to be, what controls do we need to design and implement so that they're effective for the principles and objectives we're looking to achieve. So that sort of conversation is something we are driving, and we are in a favorable position to do that. So we're learning a lot from that.
But on a practical level, one thing, if I had a wish list, is, a while ago the FCA created the sandbox environment, which as a concept is extremely powerful because it allows to experiment with a certain level of protection. I think one of the kind of things that I would hope going forwards, we can apply the regulatory sandbox to be much more integrated with the crypto custody regulation today, because I think there are still unknowns. And if it was a little bit easier to kind of parcel out a bunch of stuff as a sandbox and proceed with getting registered, I think that would create a real big differentiator for UK. So I think it feels like there are many ingredients we already have. Don't think they've been as integrated as they could be. And I think if we could integrate that, it would create UK as a powerhouse for crypto innovation. So I'm really hoping that there's more we can do, a little bit more to kind of get over the edge.
Yeah,
on timing, guys, just to interject, sorry, very, very quickly. If anybody, there's a couple questions in the Q&A, which we'll get to. If anybody in attendees has got a question, please do post it in the Q&A now so we can get to it.
There's also something called scale bots, which they're talking about creating, which will be the next evolution of the sandbox. And there's things like GFIN. So the signs are they are going to put a lot of money into expanding it. I think the key point from the sandbox perspective is just making sure it works, because you've got, someone at the FCA said this, so I'm probably coming back to some colleague. If they're listening, they'll laugh, but you don't want to get authorized to end up in jail the next 6 months later, if you see what I mean. So the sandbox is great as a sort of learning platform, all the rest of it, but it has to be part of the process. The only thing I would just also add is, there are lots of really clever guys in crypto who come up with really wizzo ideas. You don't go, I really understand crypto, I've got a brilliant idea, so I'm now going to join the regulator. The regulators got to catch up, and they're well-meaning and they're moving and they're getting educated, but this is the moment where they are learning how to interact with the world of crypto, and they're human beings. So if they get to like you, they think you're a solid chap, they think you're doing the right thing, you're in a better position than they come across you, they've never heard of you, they see guaranteed rates and they think you're robbing widows and orphans, if you see what I mean. So the crypto community at the moment, if it wants to do well, running away from the regulator will just make them think that there's a reason you're running away, so they'll think bad things. A bit like sort of the guy who runs from the jurisdiction when a crime gets committed. Probably that's a bit too emotive, but it's a similar sort of psychology. Whereas if you actually approach the regulator moving forwards, this is the moment where you can educate them. And the signs are that the FCA is learning about DeFi. The question I've got is, who do you want to educate them? Do you want to educate them because then they're coming at from your perspective, your ideas and how you see the world? Or do you want the fraud scam which turns up in Mexico to educate them when they walk into it and go, well, in that country was designed to commit massive fraud. So you're coming in, you're saying the same thing. One of the worst things I ever saw on an FCA application was a statement by the firm they want to be just like another firm, and I knew the other firm, and they were being investigated for massive fraud. At that moment, you forget everything else in the form. Your heart just sinks, if you see what I mean. You do not want, and it's the same reason why the ICOs got relabeled IEOs, STOs, and all the rest of it. I mean, that gig's slightly up, because just renaming everything doesn't work anymore, if you see what I mean. But you've got to approach them and get them to the world your way. And there's a cost to that. There's an effort for that. I'm not saying it's going to be fun, if you see what I mean. But the reward, if you get a regulator who understands what you're doing, understands how to regulate property, sees the world the way you want to see them a bit more, that is worth everything, because it means it creates a jurisdiction where it's good to operate in.
So one thing, and I speak from personal experience, because I went through the FCA sandbox a few years back as part of token market, which, having a name token market gives lots of warning signs to people to start with. One thing I would suggest, I thought it was helpful, the sandbox. I think that the people we were able to interact with were really good. One thing that I think maybe could change during that process was, it's a very long process. We were a very well-funded company, and we had to effectively stop business for a long period of time before we could act. Now, if we'd gone through traditional means of looking for an arranger license, which effectively what we were doing under a crowdfunding exemption, there is a limitation in terms of how long that process takes. You go through the traditional means outside of the sandbox, that might be 6 months, and the FCA have to give you an answer whether you're going to get that license or not. Now, unfortunately, with the sandbox, that's not the case. And as this world is quite volatile and things move quite quickly, there might be means potentially to look at that process, bringing some of what happens in that more traditional way of applying into the sandbox to say, do you know what, if you do go through this process, we're going to give you a bit of confidence that we will make a decision within this time frame. If things change, of course, we'll give you guidance after we give you the license. But by taking that approach of a sandbox, which can be never ending, it does alienate smaller startups because they don't have the capital to be able to go through that process. And I'd say, just from personal experience, I thought the sandbox was good. I think the ideals were good. I think the FCA were really open and they wanted to learn. But just that never-ending period of time, like in anything, people go towards deadlines. And if you're focused on a deadline, things normally get done and executed. If it's never-ending, you can be left out there hanging a little bit. Anyway, my rant over. Hopefully FCA have,
well, there's a question being posted, conscious of timings, but what other resources or leadership would you like to see from the UK government? What forums would be the best to do this? Is there a short answer?
I love how that's anonymous. I love how that's anonymous respondent. So yeah, be careful, panelists.
We don't know about the forums, but whoever is interested, we would love to come in and do a DeFi 101, 102, just talk about what DeFi is doing, what we do at Aave, how this new infrastructure is coming along and what the potential is, and just do more shared thinking and ideation. Now, one thing we are also, we have been seeing is more and more institutions are starting to contribute to Aave governance. So we had, quant funds come in and give us some quality advice on risk management. So we get a lot of, that sort of institutional participation is always welcome. We've done a number of these 101, 102s, just introductory sessions on DeFi. So, and we learn from those as much as, we share our expertise. So this is a time for all of us to learn what the future can look like. And we would love to just contribute to that process.
I mean, kind of looking where government intervention has been extremely successful. Israel is one really good example. There's, not being Israeli-based, I don't know if the reality matches the external perception, but certainly from an external perception point of view, there's huge amount of support from the government, both from kind of marketing, from influence, from awareness, as well as cash, frankly speaking, to promote businesses. And I do wish the government would take a look at the success stories coming out of Israel and maybe apply it to UK. I think there's a lot of learnings we could take up.
From Magnus, what are your thoughts on the amended MiCA proposal and how this will affect DeFi?
What's the question?
Sorry. What are your thoughts on the amended MiCA proposal and how this will affect DeFi?
Mike. So MiCA is basically turning everything into MiFID. That's probably a better way of putting it than that. I mean, look, it's a move towards regulation. I'm going to get done for heresy shortly, but anyway, I'm going to say anyway. I always find DeFi quite an interesting word because there's an element of centralization to literally everything on the planet, if you see what I mean. So even if you say the whole of the Bitcoin blockchain, all those who have computers linked to Bitcoin, the protocol and all the rest of it is centralized around those entities. MiCA will tend to want to hunt out whoever is centralized, or tend to want to regulate them, and it will tend to basically say that all things are MiFID financial instruments. That's their starting point. The irony is in the UK, you've got a different maneuver where we're looking at stable coins used for payment services, and we're moving into everything being a payment service. So it's funny how we tend to, lawyers by and large have no imagination. So we tend to take something we've done before, take out all the names and pretend we've written it from scratch, if you see what I mean. This is doing that from a regulatory perspective, so you can see lawyers work behind it. I know some of the guys who are involved in some of the drafting of MiCA. It is not a bad piece of legislation, but it is DeFi, and it assumes that everything is basically a security, and that's not going to be helpful, is the short of it. I think, you know, as Arjun said about principles-based regulation, to me, DeFi is a great example where it makes more sense to have principles regulation because it is currently so mercurial as to what it actually is, how it actually operates, and how it actually works. Whereas Micah is far more into, you know, if you buy and sell Bitcoin as a trader, then Micah feels about right because it's a bit like buying and selling shares, if you see what I mean. So I think the issue you're going to have in Europe is you've had 27 member states who sat in a dark room to make this piece of legislation. Getting them to change it will involve 27 member states getting in a dark room to agree a change to it. So I think it's going to be absolutely fascinating to see how it develops because they've put a marker in the stand. I wouldn't say it was necessarily a bad one. There'll be ways to improve it because these things move so fast. There's always going to be a way to improve it. And I think crypto is going to be a big test for the European model in the sense that the traditional method where you take something like a fund, funds have been around for so long that we all know what a fund looks like, so we can guess it all. It's going to be hard for DeFi. So I think the short of it is if you can successfully comply with it, you'll become a very wealthy young person because you're going to get access to a whole of Europe, but you may take the view it's just one step too far, in which case you can look at a different model. And I just finish up by saying one thing I think is interesting is you're seeing memorandum of understanding being introduced, being grouped with like the FCA, South Korea, Singapore. You're seeing a whole new trading blocks, Australia, these are whole new trading blocks being created. So you're going to get the EU trading block, you're going to get the UK/Australia/whatever trading block, and you're going to get the US trading block. And I can see different entities focusing on different trading blocks. And the one thing I'm quite interested in is the UK one involves people in both hemispheres, which means that in terms of a timing question, if you're going to have a company run 24/7, Australia plus UK makes sense just because of the timing differences between the two countries. Whereas if you're going to be in Europe, you're all going to be focused around the European time zone. So I think that, in a weird way, the ball's bouncing in the back of the net for the English model, but I'm not sure necessarily the grand strategic plan from the beginning. But I do think you're going to get these different blocks, and you'll want to create an issue for each block. And you know, at the end of the day, regulation becomes part of the core business model of these things. And if you can create a business model which makes money within a particular regulatory system, you're going to like that regulatory system. If it penalizes your business model, you're going to hate it.
Very good. I mean, I just hope Mika can stop calling stablecoins so-called stablecoins. I think it's kind of offensive when you're putting that into certain recommendation papers at this stage. I mean, you know, surely there's got to be, we don't need these snide remarks. Anyway, and I'm very conscious of time. We're way over the hour mark. I really thank you guys so much for joining us. Just to end on a positive note, maybe if we can just ask each of you, bring it back to maybe the sort of the subject of the webinar itself. Give me one thing that you think will happen or should happen in the next 6 to 12 months so that we see an increase in institutional adoption of DeFi. So Alex, one major thing that potentially can happen in the next 6 to 12 months to be a catalyst for those institutions to come in?
Smart contract-based DAOs recognized as a legal entity in their own right.
Very good.
And I think, you know, Aave Pro will launch. So we'll launch it soon. I can't give a date right now, but and then we will, you know, we already have a number of institutions, especially family offices and hedge funds, that are currently using Aave. And the only way I know is because, you know, they send us LinkedIn messages and reach out, and we love, you know, sharing expertise. And I hope a lot of institutions will participate in DeFi governance and bring their expertise to DeFi, right? And then we'll build just better infrastructure together.
Wonderful. And James?
2 words, FCA registration, which is probably mundane and says things about me, but hell, if we could just get more firms FCA registered, I mean, the 5 firms went in very early on, if you see what I'm saying. I mean, the world has changed since then. A blueprint of successful firms being FCA registered will give a blueprint to other firms to what is required, kickstart the process, and the world can keep going. And I just think it will bring an end to what I said, the fear of failure. You know, what I find funny is the way everyone looks at this and goes, we're really worried about registering people in case they go wrong. Yet if you look at every other sector, firms regularly go wrong. Once you get a critical mass of people being registered, you know, we're not here saying that no crypto firm can never bite the dust, if you see what I mean, but they bite the dust elsewhere. So once we get over the fear of failure by registering some people, then we can start moving forwards.
Okay.
Wonderful.
Thank you.
Well, on that point, yeah, thank you guys so much for joining us. Hopefully you're all okay for us to share your details, Twitter handles and what have you, correspondence which goes out. And again, yeah, thank you guys so much for your time.
Thank you all very much for your time. Thanks, Ryan. Thanks for everyone who joined, and we'll get this shared out very shortly.
Ryan, do remember to send me the GDPR consent form. It's about compliance.
Ryan's in charge of all compliance related issues.
Oh yeah, I'm a stickler for that stuff.
Good night. Thank you everyone very much.
Thanks, guys.
See you soon. Bye.